Welcome back to How Would You Beat, where we discuss how you can use jobs to be done innovation methods to beat your competition and win in your markets. In this episode, we're going to look at how you can beat your equity value multiple. So why is this important if you're a CEO, an investor, a board member, or a team member? And what is your equity value multiple? How does this work, and how does it relate to jobs to be done? So lots to talk about here. Of course, companies exist ultimately at the end of the day to create value for different stakeholders, their customers, their communities, their employees, team members, and their shareholders, of course. And shareholder value has gotten a lot of attention over the decades, and whether or not that should be the only focus of companies is a good question. But what is equity value and shareholder value? Why is it created, and why is it so important? These are critical questions that we'll look at for companies and for their investors. And how can jobs to be done help to create more equity value? Those are some important questions that we want to look at today.
Yeah, great. I think starting with what is equity value? How do you define it? How do you calculate it? And how does it play into your company's fate? Maybe start there, Jay.
Yeah, that's great. And equity value, probably the most common form that anybody can see is just look at the stock market. You know, the value of Apple or Google or Facebook or Amazon has a value. It's the market value of the company. But the question is really what creates it. And also for private companies, how do you value those private companies? I used to work for a private equity firm called GTCR in Chicago, and one of the founders there, Stan Golder, was actually a real pioneer in the 60s and 70s in valuing private companies. Even as recently in the 60s and 70s, people really didn't know how to do it. He created a method called the Chicago method, I believe it was called. But the basic idea today is that your company is out there selling products, and those products are helping people get jobs done. And that's the core of the jobs to be done innovation theory, and makes a ton of sense, obviously. The value that you're creating is really the profitability and the cash that you're generating from selling a product or service to your customers. So really, at the end of the day, your job as a company is to create customer value. And that customer value at the end of the day turns into equity value because you generate profitability, which generates cash. And if you were to value a company, there's really only a few components that are critically important. One is, of course, the company's profitability, but also its growth rate. And growth rate is incredibly important because when you're trying to figure out the equity value of a company, you're discounting the growth of those profits over time back to the present day. So when you're looking at all of those cash flows, what Warren Buffett calls owner's earnings, you can discount them back today and say, am I paying too much for this company or too little? And this was really our analysis using jobs to be done to value Apple back in 2014. And we'll put links to that if anybody wants to see the model. We can even send you the spreadsheet if you want to learn how to do this stuff. But this is really, really important for any company. It's really the same whether you're a private company, whether you're a VC-backed company, whether you're a private equity-owned company, or whether you're a public company, that at the end of the day, the goal is to generate equity value.
Yeah, and I think one really simple way to think about this is your equity value is an estimate of what somebody should purchase your company for, or and ultimately a share of your company if they're buying just a share of it if you were to sell it. And so the equity value translates to the cash you can get if you were to sell the whole company or a piece of the company. And so if you work at a company and you own stock in that company, the equity value matters to you because it directly impacts how much money you get for selling that stock. And whether you're selling that stock in the public markets or your company has an exit event by selling to a private equity firm, a strategic, another company that wants to buy it for strategic reasons, or it has a public offering where it sells to the public markets, the equity value of the company is how directly impacts how much money you will make from that transaction. And so it has an impact on, even though it seems like a very high level financially driven calculation, it has a direct impact on employees and anybody who owns any shares in the company.
Yeah, that's right. And what's fascinating, I'll just tell you a little story of how I got here. In the first 10 years of my career, when I was working in the finance industry for buyout firms, in the early days, this is in the 90s, in the early 90s, we bought companies with a lot of debt. So you can create equity value as an investor in a few different ways. You can use debt. So if you're paying $500 million for a company, but you only have to put $100 million of equity in, you can pay down that debt over time, and when you pay off that debt, the equity value accrues to you.
Right. In that example, you're borrowing $400 million from somebody else.
That's right.
And then you're paying that loan down over time.
Yeah, and I worked for a firm, and we did this very successfully when we bought Steinway. We actually owned a company called Selmer, which people may know. John Coltrane played Selmer saxophones, and they make band instruments, and they own Ludwig drums and a bunch of musical instruments. And we had bought Selmer with a lot of debt and paid down the debt. And then we bought Steinway and Sons, the piano company, for 100% debt because we could use the combined balance sheet. So as equity holders, if you're buying something for $0 in equity, as soon as you pay down the debt, you can create a lot of value. Now,
so what's the risk there?
Yeah, the risk is that you default and you can't pay back the debt, and then that obviously wipes out your equity. And the reality is a balance sheet has a hierarchy to it. First, you've got to pay your employees. They have essentially a security interest in their paychecks, and then you pay down different levels of debt, and then at the bottom is equity. So the equity holders are taking more risk. So had we not been able to pay off the debt at Steinway, we could have lost all of our equity.
Yeah, so in other words, if Steinway stopped generating cash, you would have lost all your equity. So at the end of the day, it comes down to your bet that the company can produce cash flows in some way that become larger than the debt you have.
That's right. And any first year MBA student can run these spreadsheets. And what I found fascinating and interesting that people couldn't answer with accuracy was the growth rate. Because if you're projecting to pay down your debt, or not even just to pay down your debt, let's say you bought it for 100% equity, just your returns on your equity are going to equal the growth rate of the company. So if the company is growing at 12% a year, you use no debt, and you buy it in at an exit multiple of X, it grows for 12% a year, and you exit at an exit multiple of X, the same multiple, you're going to generate 12% IRRs.
Right.
That's just
so for the non-financial people, what is an exit multiple?
Yeah. So if you're buying a company, let's say it has $100 million in revenue, and you pay $200 million for it, you're buying it at a multiple of revenue. You can also look at it as a multiple of cash flow as well, whether it's EBITDA. You can look at it as at a multiple of earnings. Public companies report their earnings. So you're always looking at a multiple of something. And a multiple is really a shorthand way of looking at those discounted cash flows. Mm-hmm. So when you look at a stream of cash flows and you discount it back and you say, well, for that stream of cash flows, I would be willing to pay $100 million. And if the company has $100 million in revenues, you're paying 1 times revenue. Mm-hmm. So there are only a few ways you can generate equity value. Now, you can do it with debt, like we did with Steinway. Essentially the company just kept growing at its normal rate. It didn't accelerate its growth at all. So we used debt, and we paid down the debt and made money. You can reduce costs. You can fire employees, or you can get better deals from vendors. You can improve your sales operations. There's different ways to improve the business. And there are investors who fire employees when they buy it. That's mm-hmm. because they have no growth thesis. If they had a growth thesis, they wouldn't fire employees. And unfortunately, this does happen in the PE world a lot. You buy mature companies, you're like, well, look, I can just fire a bunch of employees and cut costs, and then I'll make more money.
Right.
That's really unfortunate, and that's where Jousty Done is extremely helpful, because most markets, there are growth opportunities. Jared, obviously we've studied hundreds and hundreds and hundreds of markets, and Jousty Done enables you to look into there and find segments of underserved customers that represent growth opportunities.
Right.
So
just to back this up a little bit, I think looking at some examples of different types of companies, what do you see in the news and what is happening? So for example, if you see that GE is laying off 10,000 employees, well, what's happening there is they're looking to reduce costs because they're not growing their revenue a lot. So the way to generate profit and cash is to reduce their costs. And so they decide they have to lay off a lot of people because they're a public company, a large public company, and there's some shareholders who are saying, we want our shares to be worth more. We need to generate more equity value. So please reduce a lot of cost. You see this in private equity-backed companies like, I think Sears is a good example. You might remember some of the details of where the company wasn't growing, and so they decided to sell the real estate to generate cash. And that was in the New York Times, and I think it was maybe J. Crew. There was a couple of retail brands that are well known that were bought by private equity and essentially disintegrated by the private equity companies. And what's happening there is they don't have a growth thesis. They don't think the company can grow, so they have to generate cash somehow. They're selling real estate. They're selling access to the brand. They're laying off employees. And that's what we see happening in the news. That pressure to create equity value is causing pressure to create cash in some way, and they can't figure out how to grow.
Yeah, that's right. And the unfortunate thing about that is you can do a lot of financial engineering on the balance sheet side of the financial statements, which is essentially that. Are you selling assets? Are you using debt? Et cetera. But the real value in anything comes from growth. On the revenue side is looking for growth. And the Google's CFO, who's brought a lot of financial discipline to even Google, because Google has a ton of projects that don't generate any ROI or value for the company. And what she said is great. She said, if you're not building strong, durable, quality growth, your company won't persist in the long run. And of course, the examples of this are just, too numerous to cite. We like to talk about Kodak and BlackBerry and Britannica, kind of big, well-known brands that effectively went away.
Right.
And that's because they couldn't figure out how to generate growth. So what is the true value of using Jousty Done to generate growth? And there's really a couple different things that are super important for equity investors. One is to really be looking at new product development investment. So a lot of teams are working on their current product. They're selling it. I mean, this is exactly like Google. Google's been tweaking search and AdWords forever. It's a main product. It generates almost all of their profitability and cash flow. And they've spent a ton of money on new product development. And you can go to the Google graveyard. I think the URL is like killed by Google or something. And those are all projects that didn't work out. They didn't generate growth. They all got killed at some point, but Google has spent, the number might be in the billions of tens and maybe even hundreds of millions of dollars. It's so long of a history of
And you can look at that through M&A as well, right? They've bought companies for billions that didn't pan out and ended up writing them off.
That's right. And so all of that new product development, in fact, the planet, the world is just very, very bad at new product development. It's something like $2 trillion a year that's invested in like new product development and R&D that doesn't create any value. It effectively goes to zero. And so if you're an equity investor and you just bought a company and you're looking, let's just take some, kind of concrete number examples. Let's say you've got, in the company you just invested in, they've got 3% of their revenue invested in new product development. Well, that actually is going to destroy value, equity value at the company, unless it accelerates the growth. And the reason is, of course, that if you've got 0% growth acceleration, so let's just say the company's growing at 12% a year, you're unlikely to get an equity multiple increase out of that. Now, equity multiples change when the markets go up and down, but you can't control that. Let's just say you're looking at the true fundamentals of the company. So in order to really change your equity multiple, you have to increase your growth rate. So if you accelerate your growth just 1% a year from 12 to 13, 14, 15, 16, the IRR on that is just tremendous. You would go, and we can share the math and all of this with everybody, but if you had new product development as 3% of revenue per year with no acceleration, you're essentially cutting your IRR from 12% to 9%, right? Because you're spending that money and getting no return on it. But if you can change that growth acceleration 1% per year and get an equity multiple increase of just 0.7, so not even 1 times, but 0.7, your IRR goes to 33%. It's a huge multiplier. And the reason that it's a multiplier makes a ton of sense because, again, back to the idea that what a multiple is a discount on these cash flows. Well, if your cash flows are all of a sudden growing at 16% over 5 years instead of 12% when you started, that's an enormous amount of equity value.
Right.
And sorry, go ahead. Yeah.
Yeah, I was just going to say that having looked at these models, if you just play out the math of the cash you have on hand at the end of that growth, assuming the investment remains stable or at least knowable, it's a lot more cash. And which it makes sense on why people would be willing to pay for that growth. And you see examples of this in the public markets all the time, right? You see Amazon's not profitable, but they have a huge market cap. Tesla doesn't make as much revenue as GM, but has a much larger market cap. In other words, their equity value is much, much greater. Why is that? Well, they've got a growth story. And the investors are betting that growth will continue to accelerate such that in the future, the value of the company the cash flows will be much larger. And so they're saying today I'm willing to pay more for this company in order to enjoy those cash flows in the future. And so that growth story is what generates that multiple, which is what causes investors to say I'm willing to pay a higher rate against your revenue or your cash flows today because I expect it to be larger in the future.
That's right. Yeah, that's right. And if you look at those growth stories, underneath that was in every single growth story was essentially a different way to get a job done.
Mm-hmm.
Right. So Amazon clearly was a new platform to purchase products in a very, very different way and a very convenient way. So even though they started with books, obviously they were going after different categories and a huge percentage of the products we buy can be shipped through Amazon to your house, obviously. So they just kept taking market share. Even while they weren't profitable, they had very high return on invested capital, just their internal metrics between their balance sheet and their income and cash flow statements. So that's always, if you look at the growth story, it usually is a big transformation about a new way to get a job done. And that was true in Amazon's case. That's true in Tesla's case, right? Getting from point A to point B in a car is entirely different when you're talking about an electric motor instead of an internal combustion engine. And this, you can see this is what happened to BlackBerry. Right. We always mention this, but people forget that BlackBerry had a bigger market cap. They had more equity value than Apple did when the iPhone launched. I mean, that's almost inconceivable to think about now, right? Apple's so huge and dominant with $3 trillion market cap. But when we did our analysis back in 2014 using this type of multiple and discounted cash flow analysis, it was pretty clear the reason why was they were in huge markets and able to get a ton of jobs done on a new platform. Mm-hmm. And that really was the payoff, was that we know Apple uses jobs to be done thinking. Phil Schiller's, called it the grand unified theory of Apple. And they were willing to invest for the long term in that type of growth. So growth can be really risky, especially if you're an investor. Your team comes to you and says, I have a great idea. We're going to kill our cash cow iPod and we're going to launch this new phone, even though we've never been in telecommunications. So, and that's the outside world really read Apple that way. Of course, the famous Steve Ballmer, who's going to pay $600 for a phone comment. And of course, people are not buying a phone, they're buying a portable supercomputer. So the reason the outside world looks at it as very risky, it's Apple's never been in telecommunication, all sorts of excuses. But internally, the goal is to mitigate all of those risks. And that's where jobs to be done is really, really useful. If you're a board member sitting at the company and you're saying, okay, the product team's coming to me and saying, I want to invest millions of dollars, in larger companies, it's billions, in this new product development, the first thing you should probably do as an investor is say no, because almost none of that pays off. It doesn't accelerate growth. So how do you then confront that? Because you don't want to be left flat-footed like BlackBerry and have your competitors just take your share. So this is where jobs to be done is so incredibly valuable as a risk mitigation measure, because the market always wins. You cannot, and this is a whole other conversation, but the idea that you're going to satisfy latent needs that customers don't even know they have is it's so misguided. It's worth an entire episode to talk about how misguided that is. People know what they need to get done. They know their goals. They know the jobs they need to get done, and they know where they're struggling.
Don't know what solutions would make that work.
That's right. They don't know what solutions. That's right. They don't know what solutions are out there, but they know where they're struggling, and those struggles are growth opportunities. So, jobs to be done can help in tremendously lower this risk before you even invest $1 in new product development. And that's really the key, is using jobs to be done way, way, way at the front end of innovation before you even have any ideas of what the product should do, which is why we always like to say, don't start with your ideas, start with your customers' needs. Yeah. And that is a risk mitigation system for investors, so that you can build confidence that investment dollars in new product development, maybe it shouldn't be 3% of revenue, maybe it should be 10% of revenue, right? Because the opportunity is so big, and the way that you're going to approach it is clearly going to create customer value.
Right.
And that's the key, customer value at the end of the day.
Yeah, and I think that when you're a PM in a large company or you're working at a VC-backed startup, you can lose sight of this. You can start to think like, well, I'm on the payroll. They're going to keep paying our team unless something drastic happens and layoffs are created. So what does equity value mean to me? And I think that if you don't understand how investors are thinking about whether or not they should invest in your division, in your unit, you're missing a big opportunity. So I can give you an example of this. When I worked at AOL, and you can look this up, there was an activist shareholder that made our lives very difficult for a year because they didn't like the investment that AOL was making in the unit that I worked for. And what does that mean? An activist shareholder didn't like the investment. It basically means they didn't think that was going to lead to growth. Just like Jay was saying, like, you're investing 3% in product development and it leads to no growth, you're destroying equity value. So they thought that this investment was destroying equity value. And so we had to go to them, my colleagues, wasn't in the meetings, but I've helped them prep for the meetings, present to the shareholder and say, here's what we're going to do for new product development that we believe is going to drive growth. We ended up making them believe that for a little bit, and then it didn't pan out, and then the unit got dissolved and sold to a private equity fund. I think I've told this story a few times on this podcast now, but I never talked about the activist shareholder.
It's a good
before,
story.
I don't think. Yeah, and I learned a lot from it. And one of the big things I learned from this was that I don't think we had great language in that series of presentations and that product strategy for defending our position and for coming up with a great position, a great strategy that would drive growth, right? We needed more focus on the unmet needs. We needed a better understanding of the market we were in. We needed a better understanding of the market size, this target segment we were going after, and what was going to deliver growth. And that's part of the reason why I do this. If I had had that language then that I have now, I think the whole thing would have gone better. And it's are you sitting there calculating your equity value every single day as a product manager? No, you need to ship, but you need to know how what you are shipping could drive equity value, could solve problems in large markets. And if you can do that, the senior executives around you will recognize that. We'll see that you understand how this game is played. And we'll start to give you more and more responsibility over time, and you can accelerate your career doing that.
Yeah, that's great, and that's why we think it's so important for everybody to understand equity value creation. It's not a role for finance people or the CFO or just the CEO. Everybody should understand what drives equity value. And I in my early career, 30 years when I started out and I was building LBO models. It's funny you build these LBO models to figure out how much equity value you're going to create. You're trying to calculate IRRs. So is this deal going to generate 7% IRR or 27%? And that helps the investment decision. The one cell in the spreadsheet that is absolutely the most important is the growth rate.
Right.
And if you're working in a firm and you're looking at the growth rate, you type in whatever number comes up. You're like, hey, this is 15% would be great, or 20% would be even better. And, you can run sensitivity analysis and all that kind of stuff. The problem with that is what really drives that number. That is the mystery. Now, some of it is you've got a share in the market and there are more customers and you're just selling your existing product to more customers. And you could grow that way. That's fine.
Yep.
And that could work great. The problem comes from new product development. When your team is saying, okay, we're going to be accelerating our growth based on this investment in something new. And in today's world, you really do want to be building something new. It's technology is changing so fast and so rapidly in positive ways that help customers get their jobs done faster and more accurately, as we always say. But so you do need to be investing in it. But that risk, you're exactly right, Jared, comes from, well, here we just told the board or the investors or the activists, whoever, here's our idea. And you can kind of wing it and hope, fingers crossed, hopefully it works. The vast majority of new product investment fails to generate any accelerated growth. So that's really the risk. And that is where Jobs to be Done is just exceptionally powerful, because it's just increasing your probability of success by starting not with what idea you should have, what nifty new machine learning or AI or tech or augmented reality or crypto or blockchain, whatever the latest buzzwords you want to go after. Your customer doesn't care about any of those. They care about getting their job done. And if those technologies help them get their jobs done faster and more accurately, that's where you create customer value.
Right.
So if at the end of the day, it really is explaining customer value, because that's how you create equity value. Right. Peter Drucker, had one of my favorite quotes is the role of a business is to create a customer. Like at the end of the day, that's it.
Yeah, and I think that part of what you're saying is you can create growth through improving marketing and sales, but if your new product that you're trying to market and sell doesn't satisfy any unmet needs, it's a lot less likely marketing and sales is going to overcome that. So if you want to take a risk mitigated growth thesis, you should include satisfying some unmet needs in that risk mitigated growth thesis, because just throwing dollars after products where it's really unclear if they're solving an unmet need, if they're solving a customer problem, and if there's a willingness to pay to have that problem solved, is a very high risk bet. If you're going to just rely on your marketing team to convince the world they have a problem they don't know about.
That's right. That's right. That's exactly right. And the reason companies need to do this, and investors need to have the companies present this kind of investment thesis and customer value creation is because in markets, the technology and the products are changing incredibly rapidly. So maybe you have such a good product and a platform that you just need to continue to build on it. And that's certainly true. I mean, of the dominant companies in the world today, Apple, Google, Amazon, Microsoft, they've got these tremendous platforms. The phone is a portable supercomputer. It's a great platform. I mean, the reason there's an app for that is a memorable marketing phrase is because it's basically there's a solution to the job you need to get done. That's what.
Right. As long as you buy this piece of hardware.
As long as you buy this piece of hardware. So those are great examples of where you can continue to improve the platform for years and years, decades. Search is still just incredibly fundamentally important to all of our lives. Google did that one thing incredibly well, and it created a multi-trillion-dollar company essentially out of that one thing. Because so many of their other products have failed, but
it's that
one
plus
thing,
AdWords, right?
Yeah,
like the ability to find solutions to problems you have and that you're willing to pay for.
And so that's great. That is definitely you should keep, if you get a platform like that, keep building it, keep iterating it, and the same process. Figure out what the unmet needs are for search or for phones or different applications, et cetera. But if you're an investor and you just bought a portfolio company and you're looking at it and you're saying, is this the next Google or Apple? Well, great. If that's true, continue to put fuel into that engine.
Yeah.
But oftentimes companies really need to look at what are the new things that they're going to invest in that's currently not on their radar. And it can usually be two things. If there's a current product roadmap, and that product roadmap is going to accelerate growth, great, continue to invest in it. It could be that you need to reprioritize your roadmap because things that are way down on your roadmap, and we've seen this a lot, features that are, number 27 on your roadmap should be number 1. And that prioritization or roadmap, which also teams struggle with a lot. The political debates of Jay's idea or Jared's idea or Susan's idea or whoever it is, who has more political capital to get the ideas to the top. As we always like to say, you shouldn't prioritize your roadmap. Your customers should prioritize your roadmap. Where are they struggling?
And that's the way you connect that prioritization to the equity value is to make sure, you're playing in a big market. In other words, are you serving a job that people are willing to pay a lot for? A lot of people are willing to pay a lot to get done. Do you have the key struggles with that job in focus? And are you targeting a segment that's struggling so much that they might rapidly adopt a new solution? And if you have those elements stipulated in your product strategy, then the question just becomes how much of your roadmap is aligned with solving those problems. If a lot of it is aligned with solving those problems, then you're much more likely to generate growth out of your new product development. If very little or none of your roadmap is aligned with the job to be done, that's a big market, and the problems that people have with that job, then you're a lot less likely to generate growth out of your new product development. You're essentially guessing. And I think that's the key, right? Is the ability to generate that customer value, that growth drives the equity value. And so you have to align with important problems in big markets.
Yeah. And that really is the key. And that's where Jobs to be done is so helpful, is in segmenting those markets and identifying first and foremost, who are the most underserved customers? That's where you want to target. And then what is the size of that segment? And this is where Jobs to be done market sizing is so much better, because you might be underestimating the market that you're actually in. And I'll give you a great example that I think people know really well is Nest, right? Mm-hmm. Nest created a thermostat, and the thermostat market at the time was some consulting firms had done some analysis of the market size, and they said, okay, it's X $100 million a year because there's this many thermostats sold at $30 a piece. So that massively underestimated the size of the supposed thermostat market, because as jobs theory shows, there is no such thing as a thermostat market. Thermostat is a product. The job is to achieve comfort in your home. And in that case, people were willing to pay almost 10 times the price of a thermostat. I mean, if you find a market where you can sell a product for 10x the price of the current product, that's probably a good market.
Yeah. So what is it? Nest retails at like $250 right now?
$250, yeah, right.
So it's like 4x the $60 thermostat, right?
Yeah. Well, it's almost 10x the $30 thermostat, right?
That's right. That's right.
So it's huge, and also they targeted the right customer. Remember, thermostats were sold to HVAC contractors, not known as consumer-friendly interfaces. I mean, great for HVAC contractors, but they just stick this thing on your wall and you don't even know how to program it, and no one uses it the right way, et cetera. So Nest was clearly targeting unmet needs in the market for achieving comfort in your home, and they went directly to the job beneficiary, as we call it, the homeowner. That's why the market exists, not because of HVAC contractors. So that was such a good example of where you could have assessed that market in advance, to say this is a big opportunity. People are trying to achieve comfort in their home. They struggle to do it efficiently and save energy, et cetera.
Yeah.
And that's really true in every single market, is doing this analysis based on the customer's job, not the current product in the market, is the way to identify growth opportunities. And that gets back to equity value. Are you going to continue to create equity value? And it's a good way to analyze competitors who enter your market as well. So if you were a thermostat company and Nest launched their product, you could say, "Oh, I'm going to dismiss that. It's too high a price of a thermostat." Exactly what Steve Ballmer did towards the iPhone. Oh, it's too high price of a phone. Well, that you're probably missing what the job is, because people are not buying Nest as a thermostat. They're buying it to achieve their goal, which is comfort, efficiently in their home.
Right.
And Nest did a great job. They targeted unmet needs, right? No one wanted to program their thermostat, so they got rid of having to program it. All it did was automatically program by adjusting the thermostat, and then it figured out when you wanted hot and when you wanted cold.
And I think the iPhone and the Nest are great examples where the incumbents kind of laugh at the disruptor and say, "Oh, they're making a ridiculous decision. There's no way this market's going to tolerate that kind of price or that usability," and then suddenly the incumbent's dead wrong. And I think that's an interesting thing to think about when it comes to the app store and the iOS platform, because it's very easy to look at that and say it's an enormous platform. It's incredibly successful at getting jobs done. It's incredibly profitable for Apple, so clearly they should keep investing in it and sustain its ability to get those jobs done very well for developers to keep them on the platform. At the same time, if I ran Apple, I would have a team looking at, is there another platform out there that developers could build applications on that would satisfy unmet needs better than what we're doing in the App Store right now? And if so, how are they doing it? What unmet needs are they satisfying that we can't? And how do we build something new to disrupt the App Store? They might not find it in the next year, but they should be allocating some resources towards that bet. And one of the things I think about there is Web3. So Web3 is essentially a new platform for developers to try to satisfy consumer and business needs through new applications. And it's difficult to use. There's a small audience on it right now. But the question is really, can it satisfy some unmet needs that the App Store can't? And if so, what is the App Store going to do about it? Are they going to create a different platform that competes with Web3 in satisfying those unmet needs, or are they going to change the way the App Store works in order to do that? And some of the unmet needs that Web3 might satisfy are increasing the profitability or the revenue that developers can take, because the App Store famously takes, I think, 30% cut of every transaction, and Web3 doesn't take a cut. It's much lower, right, as a platform. And then there's privacy needs as well, and data sovereignty needs. And so the question is, how many people in the market care about that today, and will that grow, and is it a threat to the App Store?
Yeah, I mean, and Web3 is a whole discussion on its own. But I definitely agree with you that what companies should be doing is looking to compete with themselves. And that's really hard to do if you are trying to, if you are defining the market by the product. So if you continue to say, oh, we're in the thermostat market, or we're in the iPhone market, or we're in the keyboard device market like BlackBerry, or the encyclopedia market like Britannica, or the film market like Kodak, you can go through, all the historical examples, you're going to find it really, really hard to compete with yourself. And that is where you need the new product development investment and almost a team. And of course, famously, Apple, this is what they do in their culture. They take a team and, all the way back to Steve Jobs creating the Macintosh and the pirate flag and all that, create a team that's isolated or insulated from the rest of the company and say, okay, your mission is to put us out of business with a new product. And that is so powerful because it tells you, and maybe the answer is you don't need to invest in it right now.
That's right.
You got a great platform, keep going. And there's just, technical reasons that you can't develop a better solution today than you have on your platform. That's certainly true. But you can see how true innovators who generate growth are doing this type of thinking. Amazon's even a good example. Jeff Bezos famously says like his customers are always unsatisfied, and they're just incredibly focused on speed and accuracy to the extent that Amazon's platform is applications where you order stuff, and then their incredible logistics supply chain of planes and ships and trucks who eventually
robots and warehouses.
Yeah, and robots and delivering the package to your house, right, from wherever it came in China or wherever. But even that, he's like, well, let's use a new platform. Let's create an army of drones. Whether or not that's a good idea or will be allowed by regulators, that's another question. But you can see that they're already thinking, okay, well, who could beat us? Well, what if you ordered a package, it doesn't come in one day, it comes in 1 hour because it's flown by a drone from a local distribution. That's a new platform idea, effectively.
Right.
And Apple's doing this internally, whether it's glasses or some sort of other technology they're looking at. So companies need to be doing this. It's incredibly important to put your customer's job front and center, because that's how you not only de-risk the new product development investment that you should be undertaking, but you de-risk the idea or the ability of a competitor to come in and take share in your market.
Right.
And that's really, those are the two parts of equity value that you definitely want to get right. Make sure you're accelerating your growth in new product development, and you're also defending yourself against competitive threats. And that means taking a team internally to a company and have them just obsessively focused on the customer's job.
Yeah.
Examples we've talked about a lot are, in the music market, of course, Microsoft spent a ton of money building an iPod competitor, right? That was a huge failure. I've only met a few people that had an actual Microsoft Zune. I think the majority of them got it in a promotion. They didn't actually buy it. But at the time, I remember that's when Pandora launched and was signing up 90,000 people a day. We mentioned that example a ton of times. But what you also could see is that was just the real beginning of the acceleration of everything into the cloud. Streaming audio first because the file sizes were smaller. Of course, but then video as well. This is the era of Netflix transitioning to shipping you DVDs to becoming a full streaming service, and everything was going that way. And that may be true of Web3 or machine learning or AI. You may want to look at those technologies and say, okay, well, where are we using these technologies? Because just like streaming exploded and eventually took over everything in digital media, that's happening now with new technologies. But the technologies on their own aren't useful if they're not helping you get the job done faster and more accurately.
Right.
And that's the key, is using those customer metrics and that customer value to figure out how to accelerate your revenue growth.
Yeah, and as we've shown in this podcast, if your product development is not contributing to growth, it's contributing to a decrease in your equity value. There's only two ways it can go.
Yep.
And getting aligned with the customer's job is a great way to increase the likelihood that your product development is going to lead to growth.
Yeah, that's great. And that's what we'll do is also leave some links that people who want to see these kind of spreadsheets and this analysis and learn how to do this stuff can do it, because your equity investors are thinking this way. And as if you're a private equity backed company and you're presenting your investment thesis in new product development, this is a great way to do it so that you can make sure that you're lowering your risk and increasing your probability of accelerating your growth. As Jared mentioned, if you're on a product team in a much larger company, this is also a way to get more funds allocated to your team because you've got a better investment thesis. And,
Right.
effectively a big company is a giant venture capital firm allocating capital to different projects in the company.
Right.
So either way, whether you're PE backed or even a venture backed or large public company, this analysis is exactly the same. You have to figure out how much accelerated revenue growth you can generate with your investment in new product development.